Starting with just $100 might feel tiny. The real question is what you do next, because habits built now compound into real money later. This video gives you a straight, actionable plan to start investing with $100. It stays simple, avoids hype, and focuses on lasting results. First, decide your goal and your tolerance for risk. If you want to grow wealth over years, you can take more risk than if you're saving for a near-term goal. Your goal shapes how you invest and how patient you need to be. With a small amount, you don't need to chase big wins to learn a big lesson. With a small amount, the best move is broad market exposure rather than trying to pick winners. That means buying funds that track large parts of the market instead of hoping to find a single stock that shoots up. The idea is to own a little piece of a lot of businesses, so you aren't relying on luck. Find a broker that lets you buy fractional shares and charges little or nothing for trades. This matters when you only have $100 to start. A good setup also lets you automate small contributions, so you keep investing even when life gets busy. The three-fund approach keeps things simple and diversified. It's not flashy, but it works for beginners who want to be consistent. The plan is to split your money across three broad areas: a U.S. stock fund, an international stock fund, and a bond fund or cash equivalent for ballast. Allocate roughly 70% to a U.S. stock total market fund, 20% to an international stock fund, and 10% to a bond fund or a short-term cash-like asset. If you don't want to worry about picking exact funds, look for a single all-in-one fund that covers the U.S. and another that covers international stocks, plus a low-cost bond fund. The point is, balance, not perfection. Why these funds? They give you broad exposure with very low fees. They're easy to hold, easy to understand, and tax-efficient in many accounts. You don't need to guess which sector will outperform next year to stay on track. You just keep a steady mix and let the market do its work over time. What you need to do today is prepare your basics. You don't need a big nest egg to start. You need a plan you can repeat every month and a broker that fits your budget and your goals. Step 1 is to open an investment account. If you already have a bank account with a brokerage, that's great. If not, pick one that offers fractional shares and low or no trading fees. The sign-up process usually asks for a name, an address, and a few questions about your experience and your goals. Be honest, so you get the right setup for you. Step 2 is to decide your initial allocation. With $100, you can stick to the plan by dividing the money into percentages. Put about $70 into your U.S. stock fund, $20 into your international stock fund, and $10 into your bond fund or cash-like option. If you're using fractional shares, you don't have to worry about the price of a single share. You can buy fractions to fit the percentages exactly. Step 3 is to place your first orders. For example, you could buy 0.7 of a share of a total U.S. stock ETF, 0.2 of a share of an international ETF, and 0.1 of a share of a bond ETF. If your broker uses 2 or 3 different funds, you can adapt the amounts to the closest fractions they allow. The key is to keep the 70-20-10 balance you planned. As soon as your first orders are done, set up automatic contributions. Even small, regular deposits beat big but rare ones. If you can, contribute a small amount every week or every 2 weeks. If you're paid monthly, set up a monthly transfer. The exact amount isn't as important as the consistency. Revisit your allocation occasionally and adjust as needed. A simple rule is to rebalance once a year or when any slice drifts by more than 5 to 10 percentage points from its target. Rebalancing means selling a little of what grew and buying more of what didn't, so your original plan stays intact. Be mindful of costs and taxes. Choose low-fee funds and avoid high-cost products. Even a fraction of a percent in fees can cut your returns over time. If you can, use a tax-advantaged account like a Roth IRA or similar, because tax benefits can boost your long-term growth. If you're in a taxable account, hold your investments long enough to minimize taxes and ride out market ups and downs. Avoid common mistakes that slow beginners. Don't chase hot stocks or gimmicks. Don't try to time the market or guess which swing will happen next. Don't pile into expensive funds or use debt to invest. Keep it simple, keep costs low, and give your plan time to work. The habit part is as important as the money part. Treat investing like a monthly bill for your future. Track your contributions and how your balance changes over time. A quick 2-line note in a journal each month can help you stay accountable. You'll see the effect of consistency much faster than you think. As your income grows, scale up. Increase your monthly contributions, even if the amount is small at first. The power of compounding kicks in slowly at the start, but builds as your balance grows. If you keep investing regularly for years, you'll notice a real difference in how your money behaves without you having to chase flashy moves. This approach isn't about getting rich quickly, it's about creating a steady, repeatable system that protects you from emotional moves and big mistakes. It's about building confidence as you watch your money work steadily for you, year after year. A quick recap. Start with a clear goal and a comfortable level of risk. Use broad market funds for 70% exposure. Add international exposure with 20% and keep 10% in a ballast asset. Choose a broker that supports fractional shares and low fees. Open the account, make your first $100 fit the plan, and set up automatic contributions. Rebalance when needed, watch costs, and stay patient. Invest in yourself as much as you invest in the market because your knowledge compounds too. If you found this approach helpful, hit the like button and consider subscribing for more practical guidance on growing money without the fluff. Share your plan or any questions in the comments so we can keep the conversation real and useful. Thanks for watching, and I'll see you in the next video.